Okay, I guess we can start. Good evening, everyone. My name is Burak Uras. I am a faculty member at the Economics Department of Williams College. I have the pleasure of being one of the co-organizers of this conference and to welcome you all to Monetary Transmission in Developing Economies conference and also to Williams College. I have the distinct honor of introducing our keynote speaker, Professor Şebnem Kalemli-Özcan, a leading scholar in international macroeconomics and global finance. Professor Kalemli-Özcan is the Schreiber Family Professor of Economics at Brown University and the Director of Global Linkages Lab. She is widely recognized for her influential work on capital flows, sovereign debt, and financial globalization. Her research has shaped how we think about the links between financial markets, macroeconomic stability, and growth, especially in the context of globalized international financial markets. Professor Kalemli-Özcan is currently the managing editor of economic policy, the co-editor at American Economic Journal Macroeconomics, and previously she has held also editorial positions at other top economics journals such as Journal of International Economics, American Economic Review, Journal of Development Economics, and Journal of European Economic Association. Professor Kalemli-Özcan also serves as the economic advisory panels of the New York Federal Reserve and the Bank of International Settlements, and previously held lead economists at advisory roles at the World Bank, the IMF, and European Central Bank. Professor Kalemli-Özcan's work not only bridges academic foundations and policy relevance, but also exemplifies a deep academic rigor, empirical rigor, using both micro and macro level data to inform some of the most pressing international macro and macro development questions of our time. Tonight, we are fortunate to have her speak on monetary policy, making and transmission in developing world, a topic that could not be more timely. Please join me in welcoming Professor Şebnem Kalemli-Özcan.
Thank you very much, Burak. It's a very gracious introduction. I am very happy to be here at Williams, my first time here. Amazing place, such peace and calm. I just came this afternoon, and can we all escape here from what is going on in the world? That's the feeling you get. Yeah, I would like to tell you about, thank you again so much for inviting me. I would like to tell you about monetary policy making and transmission in the developing world. This is a topic dear to my heart. I have been working some time on it. So the talk is going to combine key insights from several papers. That's why you see this disclaimer at the end. The research I'm going to tell you about is going to be based on my own solo author papers, but also joint papers, where some of those joint papers are co-authored with colleagues at the IMF and Federal Reserve. So I have to tell you the usual disclaimer. These are our views, and they don't represent the views of Federal Reserve System, IMF, and IMF's board. All right, so this, this topic that I started thinking now almost a decade ago, basically, starts from this question: do monetary policy making and its transmission differ in developing versus developed countries? We all, know and feel that there are differences. That's mostly because most of us are from other countries and we know how things work in our countries versus the United States or the other developed countries. But still, it's a question that bothers us, right? This is annoying. If that is the case, there is enough evidence that is the case, but why that is the case? So why question maybe bothers us more because, by nature we are economists. We like to explain things that are relevant to the real world. So, and also there is this other, not very comfortable thing that the US has a big role, right? US has a big role, and that's also what we want to understand. Is it because US has a big role in financial markets, or is it because dollar is the reserve currency, or is it because US policies by itself carry a big weight because US happens to be a large country? So we kind of want to, answer all these questions, and I'm going to provide like a potpourri of results, try to get at each of these questions and also link between those questions. So the starting point is, emerging markets, right? I mean, you can think this as a all the developing world, but emerging markets is where we want to start, because emerging markets is really this between stage. You know, they are also developing countries, but they are not very poor, and obviously they are not rich, so they are not developed. So they are literally like going through the transition. And because of that fact, we have a lot to learn from emerging markets, because things are happening, right? There's a lot of variation in the data, things are happening. So basically, you know, you start a very underdeveloped country, you know, you start developing, this is kind of your first stop. So what is going on in those countries is going to be very important. And one thing we know about those countries is they are largely exposed to fluctuations in external financing conditions, right? You talk to any emerging market policymaker, or, you know, more kind of low-income developing countries, they will all tell you the same thing. But the difference is, you know, they will all tell you that we are subject to external funding conditions, but emerging market policy makers will tell you, look, no, this is really a problem. This is really a problem. Somehow we need to get around this problem, right? So we have to do the policy, you know, within the realm of this problem, that external funding conditions really affect us. Okay. How do we think about this, we being economists? So there are two ways to think about this. So if there's this external exposure to external funding conditions, obviously, as economists, we have to think about the trade-off. And we have to think about the challenges, right? So the policymakers immediately start thinking about the challenges, how challenging that is to their monetary policy making or other policy making. But obviously, we like to write models with trade-off as economists to really understand where the problem is, so we can offer a solution. So the trade-off is generally known as, this goes back, you know, very, very old literature actually. So, you know, generally it is kind of regarded as started officially in academic literature with the fear of floating paper of Carmen Reinhardt and Guillermo Galvo. But it goes even before that. If you look at the literature, there are papers in, like, you know, 80s and 90s before their paper, early 2000, that talks about this trade-off. And what is a trade-off? Trade-off is, are you going to increase your monetary policy rate or decrease your monetary policy rate as a monetary policy maker in an emerging market when your country is in a recession? Why this is a trade-off? Because most of the time when the country is in a recession, there's also this capital outflow from your country, right? So you lose funding, and that is going to call for an increase in interest rate, but recession is of course going to call for a decrease in interest rate, okay? So this is a trade-off. That is a problem, a trade-off for emerging markets, developing economies. This is not a trade-off for advanced economies. You know, US doesn't have this problem, European countries don't have this problem, Japan don't have this problem, they don't have this problem. This is specific, this trade-off is specific to these countries. And the challenges, you know, generally thought of, I mean, challenges thought together with the trades-off before, until Helen Ray's famous 2013 Jackson Hole paper, where she said, like, look, the way to think why this trade-off challenging is we really have to think about the classical Mendelian trilemma, and where if we want to have an independent monetary policy, free capital flows, then all we need to do is just have the exchange rate to be flexible. She was basically saying we should move away from this trilemma. That's the challenge, right? Why? Because even you say, okay, I want to have independent monetary policy and free capital flows, so I'm just going to let the exchange rate do all the job, so I'm going to have floating exchange rate. What we learned is that's not enough. So you just cannot give the job, basically, to the exchange rate, right? That's the challenge. The challenge is exchange rate is not going to do the job for you, you being here the emerging market monetary policy maker, okay? So that's the trilemma versus trilemma debate. All right, so we want to start from the first point, like, okay, why don't we first document what are they doing? Okay, we understand the trade-off, we understand the challenges, we can have endless debate about optimal policy, what they should be doing. And there is an endless debate about this in the literature. So in our research, we said, why don't we take a step back from the should question and first, like, try to document what they are doing, just what they are doing. I mean, forget the should question for a minute. First, try to understand what they are doing. Why we kind of did that? Because we really want to understand the environment these guys are operating, the trade-off and the challenges, okay? What are they doing? What do emerging market central banks do? And when we started this research, the consensus is actually monetary policy is procyclical, meaning, you know, they do the wrong thing, right? So they do tight policy when the GDP is down, and then they do loose policy when the GDP is up. So it's kind of the wrong way, okay? So that's the consensus when we started this literature. Then we also ask, well, if we change that consensus, if we can show that, no, actually monetary policy is countercyclical, it is acting like the Federal Reserve, like the ECB, but then why it is not as effective maybe that's another way to ask the question. Then we said, okay, can we tie it back to the exposure to external finance, okay? And how is that a challenging thing for these countries' central banks? All right. Now, this is a very relevant debate. I mean, it's an academic debate for sure, but it's also a policy debate. You can imagine that I talk about this topic in many places, and to show you how relevant also it is from an academic perspective, not just something central bankers talk among themselves, I'm going to provide 3 quotes here. First is Woodward. Woodward is obviously a closed economy macro view, very leading scholar in terms of telling us how monetary policy works, how monetary policy transmits. And Woodward says, I find it difficult to construct scenarios under which globalization would interfere in any substantial way with the ability of a domestic monetary policy to maintain control over the dynamics of inflation. Okay, so it's a perfectly valid statement when you think about the United States or European Central Bank or Bank of Japan, Bank of England maybe. But then Ray takes the other extreme position to Woodford and says the monetary trilemma is really a dilemma because open economies can exercise no monetary autonomy from the United States policy or the global financial cycle unless they impose capital controls. That's, a quote from her paper. Mario Opsveld, when he was the chief economist at the fund, took a mid-view between these two extreme views, says an independent monetary policy is feasible for the financially open emerging markets, but limited in what it can achieve. Okay, so this is, if you will, more realistic statement that is fitting to those trades-off and the challenges. Okay, so some of the results that I'm going to show you maybe in some figures, here is in the summary form, is going to be as follows. So in our research, we actually find, basically something very close to what Opsveld is saying. Monetary policy is counter-cyclical, and it is independent from the US monetary policy. It can be independent and can be counter-cyclical, meaning central banks are lowering policy rates in emerging markets and actually in certain developing economies too during recessions. Okay, so you lower the policy rate during recession, that's a counter-cyclical monetary policy. Now, how do we, end up with that conclusion? We look at Taylor rules. The same Taylor rule used in the US. We show that central banks in emerging economies generally adhere to very similar type Taylor rules. So their central bank reaction function is similar. B, policy rate is positively correlated with GDP growth. So this is, you can look at these type of correlations over time dynamically. And policy rate lowered around episodes of global stress, also exogenous monetary policy tightening. So episodes where country loses capital flows and also country slows down, maybe goes to a recession. We actually find that policy rate is actually lower. So again, a counter-cyclical monetary policy. Then we said, okay, so where is this consensus coming from? Why people think, it is pro-cyclical? We started presenting the paper and then everybody's like, we couldn't even pass the minute 2 because there is, what are you talking about? So I'm like, wait a minute, okay, so what is going on here? What did we miss? So there's this very deeply ingrained thing in people's brains. Later we figured out, where that comes from. I can tell you during Q&A if you want to, but there's this belief that no, in developing countries and emerging markets, basically every country that is not developed, they are running a pro-cyclical monetary policy. So we said, okay, where is this coming from? And then they point you to papers, data and all that. So we look at it and we actually find out that short-term market rates, which are taken as the same thing as a policy rate in the United States, they are actually deviating from policy rates and they do show a pro-cyclical pattern. So what we show that actually in emerging economies, there is this wedge between the policy rate, between what the monetary policy maker, targeting or using, and the short-term market rates meaning rates on lending and borrowing in short term, and that wedge is a counter-cyclical wedge. Okay, so in advanced economies, there is no such wedge. There is no difference. When I say short-term market rate, think like a 3-month treasury rate. Do you think a 3-month treasury rate is different than Fed funds rate? No, it isn't. Okay, so that's apparently not the case in these countries. That's what we discovered. And then we also, so we have a name for this thing, this wedge between the short-term market rate and the monetary policy rate. We call it short-term disconnect. And we show that this short-term disconnect is related to actually economies' external exposure to financing conditions. Okay, so tighter conditions are going to lead to these wedge going to open up or close down, and that's going to affect your pass-through between the policy rate and the market. Okay, let me tell you this story. This is a summary in figures. So what I would like to do is I will show you some empirical evidence on the behavior of policy rates using the standard central bank reaction function, then correlations with GDP growth. Then I'm going to look at these famous events like global financial cycle, COVID, and taper tantrum. And then I will also use an exogenous US monetary policy shock, what literature calls this identify surprises, to show you the same thing. But basically, this A, B, C, D is going to tell you the same thing. It's just like 4 different ways of showing the same thing, that monetary policy is countercyclical in these less developed countries. Okay, so this is a Taylor rule. Okay, so it is very standard. Monetary policy rate regressed on the lag monetary policy rate, inflation, output gap. Okay, so it is standard in every country. So we run the same exact regression for emerging economies, advanced economies, and the estimates on inflation and output gap. They are not exactly the same estimates, but we back out the Taylor rule coefficients, and you get very ballpark similar numbers in emerging markets and in advanced economies. And we did a lot on this in the paper, like adding the exchange rates to this, using GDP growth instead of output gap, all those robustness things. Pretty much the result is not changing. Then we said, what about a dynamic correlation? So why don't we look at these correlations where people do to understand procyclicality, countercyclicality? How do you do that? You regress in a dynamic sense, in a local projection sense, the policy rate on GDP growth, right? So then do this over 8 quarters here. So what this beta is going to tell you, when the economy is growing, when this is up, and if this is positive, that means interest rates are going to go up. When the economy is not growing, so the growth is negative, this goes down, then interest rates is going down, which is, again, counter-cyclical monetary policy. And you see that, this is, again, exactly the same way, right? It's a positive coefficient both in emerging markets and advanced economies. These scales are the same, so you immediately also see, well, but it is not as counter-cyclical as advanced economies, right? You can definitely say that. Why is that? I mean, you can tell many stories, right? It can be fear of floating, it can be supply shocks. A lot of people have different theses here, but generally still the directionality of this and the Taylor rule that I showed you before, both are going to tell you that policy rate is going to be, policy is going to be countercyclical, policy rate is procyclical, policy is countercyclical. Okay. Then we do these 2 distress events. So this is global financial crisis, August 2008, emerging economies, advanced economies. You see everybody losing, so the median and the mean country. Of course, there are outliers. You can see Russia, Hungary, they are actually tightening. There's also an outlier in advanced economies. I'm sure you know who this is. This is Iceland, who was going through a very tough time and had to put capital controls, which in turn ended up investors suing their central bank governor and the deputies, because obviously if you put a capital control in the middle of a sudden stop, you are breaching a contract. If you don't let foreigners get their money out, that's a breach of contract, you can be sued, and that's actually what happened. Anyway, so that's another story, but yes, there are countries, of course, doing the other thing, but overall, mean and median country, mean and median advanced economy, mean and median emerging economy, they are losing the monetary policy, cutting the rates. Same thing here with COVID. Okay, so everybody's actually losing the COVID. So now you can, of course, say, well, COVID turned out to be a very different shock, sure, but that we didn't know in March 2020 how it's going to turn out. So at that moment, it was a purely uncertainty shock. We didn't know what's going on. It was an immediate recession, remember, before all the policy action, it was an immediate recession. And countries are losing. Okay, then the final thing we did is, use this exogenous US monetary policy shock. What is this? This is Gertler-Karadi instrumented 1 percentage point exogenous increase in the Fed's funds rate. So what is the response in emerging economies to an exogenous US monetary policy tightening? Basically, that's what is this doing. And here, all these results are shown in other work too, but basically the typical story, US tightens and then GDP growth goes down, inflation goes up and down, capital flows go out. All these bad things happen in emerging markets. We know it is shown in a series of papers, not just in our paper. Our difference from all these papers is all these bad stuff is happening when the central bank in emerging economies is loosening the policy. So in spite of the loosening the monetary policy, still those bad things happen. GDP slowing down, capital flowing out, and all that. Right. Then we said, okay, what is going on here? Let's now just put this policy rate story aside and let's look at the market rate. So let me first be clear on the definition. What is a policy rate? Policy rate is a target interest rate set by central banks in their efforts to influence short-term interest rate as part of their monetary policy strategy. So the short-term market rate relevant here is going to be a treasury rate, which is what governments issue short-term bonds. Okay, that would be the thing that you would look in an advanced economy, and the same also in emerging markets. All governments borrow domestically in emerging markets at these short horizons. So the benchmark thing here is going to be 3-month treasury rates or 3-month government bond rate. Both in emerging markets and advanced economies, that's something widely available, and we are kind of trying to do apples to apples here. Okay. When we look at that, we now find something very interesting. Okay, again, I'm showing you the emerging markets here, advanced economy. So this is this dynamic correlation over 8 quarters. And I label this as interest rate. Why? Because the blue is the policy rate that I showed you before. Remember, policy being countercyclical. During good times, you tighten the policy in emerging market. During good times, you tighten the policy in advanced economies. So on that blue figure I showed you, now I superimpose this market rate, which is the 3-month rate the government borrows at, the government bond rate, and look what happens here. So this thing in advanced economy is exactly the same. There is no difference between two. They are exactly identical, but look what is going on in emerging market, right? You can see that when times are good, the policy tightens, but the market rate goes down. They have very different dynamic cyclicality, okay? And clearly, this is something very important in assessing the cyclical stance of monetary policy in emerging markets, because obviously, if you are going to use it, and if you are going to use it, you are going to end up with different conclusions in terms of what these developing country central banks are doing. Before even you go to the what they should be doing question, what they are doing, you are going to get that wrong, depending on just simply what rate you are looking at in the data. Okay, and this is the wedge, right? So you subtract blue and red, you get 0 in advanced economies. There is no wedge. This is what we call short-term disconnect or short-term wedge, market rate minus the policy rate. In emerging markets, you see this is a counter-cyclical wedge. Okay? All right. Okay, so I have another 20 minutes, I believe. Is that correct? Okay. Okay, all right. Now, given this, then we say, okay, we established this. Now, what about, can it be that because they really do different monetary policy, right? We are finding something, but it is really not, you know, there is a market mispricing or there's something happening in the market related to financial markets, but it's just that the way they do monetary policy is different. For example, these are all inflation targeters? Or are they, you know, targeting money supply? Or are they doing an interest rate rule? Is there a Fed funds rate? I mean, you can ask all these questions, right? So we look at that, and it is true, and different countries do it differently, obviously. It is hard to do an apples to apples here. But, you know, especially after 2000, 2005 and so, there is a lot of adoption of inflation targeting, right? In fact, it is known as a success story for developing economies and emerging markets. So we separate the inflation targeters, interest rate policy framework guys, so we do more in the paper, but basically when you do that, you see that it doesn't really matter, you know, if they're inflation targeters or interest rate policy. In fact, you know, when you look at these counter-cyclical monetary policy and the wedge, the black one is the one I showed you by pooling all the countries. And when I separate the inflation targeters only and the interest rate policy only, you see the wedge becomes even more counter-cyclical. So you do even kind of more rule-based, you know, proper monetary policy like inflation targeting, your wedge is becoming even more counter-cyclical. So it's not, it can't be about, you know, you are doing something wrong in the monetary policy realm, right? Inflation targeting frameworks are very well defined, very comparable. There's like IMF behind this. You know, all the countries' frameworks can be comparable. So this is interesting to us. Okay, so that means it is not the way you make it, but somehow there is this market pricing during good times that is going to push the market rate down, right? So even you do, you know, kind of a proper monetary policy like defined as inflation targeting, you are still going to be subject to this. So why is that? Why is that? That's the next question we ask. And before we ask that question, we also do the same US monetary policy shock. Remember this exogenous US monetary policy shock now for market rates. Remember, before I showed you when US exogenously tightens, GDP growth goes down, capital flows out, and I told you those bad things happen in spite of the policy rate going down. But look what happens to the market rate. Market rate goes up. Okay, so again, exactly telling you there is this wage where policy rate and market rate moves in a different direction, even with an exogenous tightening in the US monetary policy. And the final exercise we do to just really show this fact as a robust fact is this taper tantrum. This is May 2013. If you remember, Ben Bernanke made a speech talking about how they are thinking to start the normalization of the US monetary policy, because this is the time basically they wanted to get out of the QE of the 2008 and afterwards, and somehow after that speech a whole panic started, capital flows out of the emerging markets, exchange rate depreciated, and all those things. And during that event, a purely exogenous, unanticipated event, I mean, Fed even didn't tighten. So there wasn't even a tightening. It's just a Ben Bernanke speech, you know, signaling an upcoming tightening. So it's a purely unanticipated exogenous shock to the emerging markets, and you can see how policy rates all go down, except these two. This is Brazil, and I believe the other one, I don't know, the other one is Indonesia, Brazil and Indonesia, because we look at the IMF article falls here. And these guys both came out and say, we are tightening because exchange rate depreciating very fast, and we want to guard against that. So they told us why they are doing it. But with those, put those two exceptions out, they are outliers. Pretty much all the emerging markets are losing when everybody's market rate going up, except with one outlier. And here's the wedge, right? So the wedge is going to go up here because it's the market rate minus the policy rate, because it's a tightening financial condition situation with taper tantrum, so the market rate is going to go up. Right. Okay. So then we say, okay, can we explain this phenomena with this external exposure? How are we going to measure external exposure? I mean, you can have several measures. So we are going to go with something that we actually learned from the policymakers, right? I mean, if you are an academic sitting in your office, you are probably going to go to the IMF website and see how these guys measure these things and look at the latest paper published, what they use, and you are going to use that. We said instead, okay, we are doing all this to really understand, the policymaker situation in emerging market and developing economies, like what are their trades-off, what are their challenges, so why don't we ask them? And when you ask them, and I'm sure you know this very well in this room, they tell you, the first thing they tell you, the domestic banks are the market makers, okay? So you cannot do anything without domestic banks in emerging market. This is something very hard for me to communicate to my American or European colleagues at the Fed or European Central Bank, but this is something very well understood when you are talking to an emerging market and a developing country central bank policymaker. So it has to be somehow, the external exposure measure you want to do has to be related to domestic banks' intermediary role. Because domestic banks are the market makers, domestic banks are the ones bringing the capital flow to the country. It is not the stock market, it is not the bond market, because they are very shallow, okay? The money coming into the current country through domestic banks. All right, so that means we can look at domestic banks' external liability share. So how much money domestic banks are bringing to the country. So capital flows into the domestic banking sector instead of the entire country or instead of the stock market. And we also would like to know, because when the policymakers tell you these guys are market makers, that means they have significant holdings of government bonds, so they have power to price that short-term market rate. That's what the market maker is, right? So they are the relevant gateway to external market, and they are pricing things in the domestic market. Okay, so we are going to look at both these variables, and these are of course going to be like quantity variables. And in terms of pricing, we are going to look at here the standard MB or SEMB spread. MB is the the rate government borrows, and the SEMB is the rate corporate borrows. So it's just like a rate that tells you how much extra you need to pay if you are not a U.S. bank or a U.S. company or U.S. government. All right. Okay, so we will use these things. And here, let me also give you some numbers in terms of big picture facts, because this is also a point that people really confused a lot about, because, again, this is an artifact of not using a comprehensive data set in international finance, but just go to the data set you can get, and that data set is going to just give you a snapshot, and then, of course, there's going to be this tendency to tell that's the general story. This is not the case. For example, I'm sure you heard a lot, global liquidity is all changing, global finance is changing, it is all about the shadow guys, non-banks, and all that. This is a very niche north to north advanced country phenomena. I mean, not even affecting all the advanced countries. But those data sets are very available, high frequency, people work with them, and people then write these papers as like these are general facts. Here are general facts. These are all from, you know, supervisory, administrative, confidential data. And what they are going to say is domestic investors hold 61% of corporate and sovereign bonds, where foreign investors 39% in emerging market and developing countries. This is a home bias. So if you write down models of home bias, right? Okay, but when we come to data, we are too quick to say, oh, there's this huge money coming from these certain investor to these countries. No, there isn't a huge money coming to these countries. In fact, most of the investors are going to be domestic. This is exactly why World Bank now trying to really make those domestic investors matter, because there is more money coming from the domestic investors than the foreign investors. Now, for sovereign debt, if you just like look at something that, you know, we have very good data on, domestic banks hold actually 26%. This matters for this research because we want to understand who prices this three-month market rate. Domestic non-banks, but again, they are important, but they are in the country. They are 28%. Foreign banks, not much. Foreign non-banks, not that much. Domestic central banks and foreign central banks. Okay, so this is the breakdown of these 39, breakdown of this 61. Okay, so basically then what happens is, and if you look at this country by country here, all developing countries, how much of the government bonds held by resident banks, domestic banks. So you see that this is a range going from 60% to 10% in Israel, 60% in Egypt, right? But the point is EM average is like more around 30%, or, you know, kind of this number I gave you, 28%, whereas the advanced economy average is very low. Now, this is cross-section. If you look at the time series, the same thing, right? If you look at the resident bank in emerging market, look at this blue line versus the resident bank in advanced economies, so domestic banks are going to have a lot of power, okay? So this is going to be important for us because, you know, I'm not going to present here because I don't have time, but based on this, you can show in the data that, you know, these domestic banks' external exposure are going to help you to explain those disconnect wedges I showed you about. So you can connect the disconnect wedge to at what rate domestic banks finance themselves and how much money domestic banks borrow, you can connect the two. And then, you know, in the research, you also write down a model to, you know, take these regression equations that we take to the data from the model. Now, why this is important, I want to say two more things and then conclude. Why this is important? If domestic banks have such an important role, you know, bringing the money, pricing the three-month rate, which means you are going to create this, you know, less than fully effective monetary policy. I mean, that means that this external funding condition volatility, both in terms of spread and in terms of how much they can borrow, these domestic banks, that volatility is fully passed through the market rate, okay? That's why you have this disconnect, because, you know, these guys are bringing the dollars, but the way they bring the dollars subject to this volatility in the external funding condition, and we are not taking a stand here, whose fault is that, you know, put that aside, but because they have these cost of funding and amount of funding in dollars, the domestic banks, they are going to pass that to the country through these market rates. And they can do that because they hold up to 30% of these domestic bonds, so they can actually do that pricing, and that's the model we write down. Now, why do we care about this in the big picture? Because of these macro facts. These macro facts, now, here's how we link to the transmission, right? This is from monetary policy making to transmission. These macro facts is about, okay, if these global conditions, global financial cycle, US monetary policy, all these external funding conditions so important, and if it is going through the domestic banks, then, you know, how much of a stance I should take as a policymaker in terms of trying to regulate that, how important this is. So here, it is actually telling you that it is going to be extremely important. I'm going to show you 4 figures here. Each figure, this black line, is going to be a measure of external financial conditions, what I call GFC, measured global financial cycle, measured with VIX. Okay, all of these figures on this axis in black is going to plot your VIX. And the blue line is going to be something else. So here, this is the lending rates. This is actually Turkey. This is a specific country, Turkey, not all the emerging markets, because we do this from the microdata ground up, aggregating everything up, because we basically have the entire thing. We observe everything. It is supervisor data. So for Turkey, but then Turkey is going to be typical. You can do it for other emerging market countries too when you have the data. But this is basically saying when the VIX is high, so when the global financial conditions tight, then your lending rates in the economy is also going to high. When it is low, it is low. So if you plot the policy rate here, policy rate is going to be less effective. So this is showing the same thing I just showed you with short-term disconnect in a different manner, saying your own lending rates in your own country in terms of your households as firms tied to up to 50% to a global financial cycle variable like VIX than your own monetary policy, okay? Why is that? Again, this is the banking story. Here I show you how much banks borrow. This is non-core liabilities, this is how much banks borrow from foreigners. And then you can see there's a negative correlation right now, right? Because when the VIX is high, when the conditions are tight, global conditions, bank borrowing goes down. That feeds directly to the UIP. Why? Because UIP is a condition that tells you the relative price of dollar borrowing versus peso borrowing, dollar borrowing versus Turkish lira borrowing. And of course, the gateway, the banks bringing the money to dollar, and then they can also do Turkish lira lending or peso lending, right? So this is going to say when VIX is high, when banks are finding it difficult to bring money, so their capital flow is going to go down, UIP is also going to increase, right? Exactly the same time when the lending rate increases. Because UIP is increasing because now UIP on the peso, UIP on the Turkish lira, on the local currency is going to be higher. It is going to be more expensive to borrow on, in your local currency vis-a-vis the dollar. That's why it is increasing. So dollar might be getting expensive, but your own currency is getting even more expensive. Again, why? Because your monetary policy it doesn't have a one-to-one pass-through. And then finally, we say that there is a zero correlation between the collateral used, right? Because generally the story told through collateral in the advanced economies, here it is a very much a funding cost through the domestic banks, passed through the lending and borrowing rates domestically in the country. Okay. And the final thing I will say is, based on this, IMF now had a whole new framework called Integrated Policy Framework. You can go to the IMF website, look at the Integrated Policy Framework. The idea is what other policies we can advise countries so that they don't try to tweak the monetary policy, they don't use the monetary policy, because monetary policy is already not having 100% effectiveness because of these external funding conditions. So what other policies we can teach and recommend countries to deal with these external volatile funding conditions? That's basically what Integrated Policy Framework is about. So I work at this as a senior policy advisor to Geeta Gopinath when she was the chief economist, and when you go to this website, you see there are all these IMF papers, and from the academics, it will be basically only my paper. Actually, they cite my Jackson Hole paper, and they build on that. And the building on idea is like, okay, we have to really understand about this UIP wedge, which I showed you in the previous figure, because that wedge is going to pick up the relationship between how hard, how volatile now this external funding to my domestic banks and how that is passing through to my domestic household, to my domestic firm. And then they come up with these policies, what they call CFM-MPM. So this is open form is capital flow management macro-prudential measures. And then they argue that, okay, so if we somehow use these policies to prevent the spike in the UIP premium during these type of shocks, like a VIX shock, like a COVID shock, uncertainty shock, or a taper tantrum, then we can help countries to smooth out. And here's an example of that, Brazil and Mexico. So this is again taper tantrum. You see the second quarter of taper tantrum, May, and you see that Mexico has a higher increase in the UIP wedge compared to Brazil. Why? Because Mexico basically adopting these type of policies. So this is their proof of that. Okay. To conclude, these risk on-off shocks or volatile external funding conditions, however you want to call it, these things can explain a large part of the domestic credit cycle in emerging markets and monetary policy transmission, meaning monetary policy can try to lean against that, but they are not going to be able to fully offset it just with the monetary policy, right? And that's actually something very well understood by the monetary policy makers. That's why they are not trying it, right? They are actually trying to do the right thing. When the economy slows down, they, decrease the rate, and they don't try to hike the rate and try to, work against that. But this doesn't mean, these guys, doesn't need help. They need these other policies. And the other policies attacking this channel. Because the channel here is a falling risk premium, lowering the borrowing cost for the average firm, regardless of your collateral constraint, that are not going to be impacted by capital flows. So what does it say for the policies? If you only design policies to limit the dollar borrowing in your country, okay, that's not going to be enough. Because as long as you have an open country, as long as your banks bring the dollars, they can convert it into pesos and still lend in pesos, that lending rate in pesos is still going to be affected, right? So just like minimizing dollars or a capital control or like preventing households and firms borrowing in dollars is not going to solve all the problem. Why? Because there's going to be this lower borrowing cost also in your own currency. These counter-cyclical policies on the banking sector might solve a large part of the problem. Again, this is IMF's claim. We don't do research on that directly, but they have research arguing this. So if you do this, then you don't have to resort to this like panic mode policies during the time of shock, which is either FX intervention or tightening the monetary policy, which is pretty much what happened a couple of weeks ago. If you're following Turkish case, there was a political uncertainty, of course, huge capital outflows, depreciating currency, and central bank have to hike the interest rate and at the same time did a lot of FX intervention, right? So IMF argues that you shouldn't be in that position of doing that, especially if you are already a country trying to fight inflation and accumulating reserves. So why you have to answer these shocks in a panic mode like that? So do things before, that's the IMF's argument. And the last thing here cut off is basically saying, if you are a country which is not going to be then making you a developing country, but if you're a country, if your corporate sector entirely borrow by themselves, directly issuing in New York, then of course you cannot do anything about that, right? Because that is completely bypassing the domestic financial system, domestic monetary policy, and they are issuing a bond outside. But let me tell you, there are very, very few countries like that, definitely not in developing, even in emerging markets. There are 5 firms in Turkey that can do that. In Brazil, not more than 10, a giant emerging market, similar in South Africa. So that is definitely not the story here. Thank you very much.
And I would like to especially encourage our CD fellows. I know that you guys heard a lot about money, finance, and macro linkages from Professor Katner, from myself, Professor Kim as well. I see that Professor Kim has a question. Maybe we start with him and then.
Thank you for the talk. It was super interesting. I had a quick question about the short rate disconnect, and it seemed to be correlated with like risks and UIP deviation specifically. Yeah. In that case, thinking of UIP gets me to think about like FX intervention policies. Would like FX intervention be helping mitigate this, or would that like worsen this? I think it could be related. I just don't have a good intuition as to like which direction it might go.
Yeah, this is a very good question. This is a big debate in the theory literature. Because in the theory literature, you can get both answers, right? It is going to depend on how you write down the friction, right? If you write down a risk-sharing friction, then yes, FX intervention solve all the problem. Why? Because in those models, UIP deviation is about not finding dollars, and FX intervention is just throwing the dollars. So the problem solved, right? Okay. If you write down more kind of like in the older literature, this over-borrowing friction and more, through externalities and things like that, then it depends. Then it might make it worse because UIP, even you throw dollars with FX intervention to this UIP shock, if UIP also somehow related, it's not an exogenous shock, but if it's related to monetary policy itself, then it's going to make it worse. Because then it's going to have the same effect as increasing the interest rate. Why, in the old days, when you see these events, capital flowing out, exchange rate depreciation, you start hijacking the interest rate, right? Why that didn't work? Because normally it should work, right? It's going to bring back the capital flows, it stopped the depreciation. But what happened in those instances when central banks tried this is the country ended up in recession, right? And without actually limiting the fall in the exchange rate. Because of the risk premium, right? Because if the UIP thing is a risk premium, and that risk premium is endogenous to the policy making, then increasing the interest rate is one of the worst things you can do because that is not, because everything is, all the risk premium is now still feeding to the exchange rate. Exchange is still depreciating, and by increasing the interest rate, you are just like crashing your economy, right? And if you talk to the actually some now advanced, previously emerging market countries. So this is actually very, very teaching. Like, you know, when I talk to Israel Central Bank, Australia, Korea, I mean, they all said we learned this lesson the hard way, right? If it is some sort of shock and how UIP now becomes endogenous to some confidence, risk, you know, all those things, some mess in the policy making, then increasing the interest rate is going to make it worse. Yeah, yeah. But if it is just, I just cannot find enough dollars, yes, then of course you solve the problem by throwing dollars to the problem.
Thank you, Professor. I'm Manzoor Morshed from Bangladesh. Actually, I'm not an economist. I'm still learning. So my question may be very basic, but I wanted to ask this question to you. Thing is, recently, I mean, after COVID shock, every country in the world, I mean, had major economic breakdown. Also, after the Ukraine-Russia war, I mean, it also affected all the country, especially my country, Bangladesh, Pakistan, other country. They went to IMF for extra fund, some reformation was going on. But what is happening in current in US, like President Trump has so many strategies. I mean, these are going to be affecting all the countries, especially I can see it's some economic pandemic is coming on within next 1 or 2 years because because it is impacting the reserve of the country. In the meantime, countries cannot export because there is a lot of trade war is going on. So ultimately it will impact their the money flow within the countries. So, but there needs to be something should be done immediately. Either there will be some gap. If US cannot act immediately, other may take the chance to fill the gap. So in that case, I wanted to know what is your opinion to fight this kind of future economic pandemic. Also, what should be done by the other governments? Thank you.
Okay, I really like relabeling the current US administration as an economic pandemic. I think that's very well put. It is an economic pandemic, yeah. Okay, so, I mean, unfortunately, I mean, I have a paper on networks, tariffs, and monetary policy, which is more trying to tell what the US Federal Reserve and ECB to do. You're right. I mean, emerging markets here, unfortunately, caught in a very bad situation, especially countries like Bangladesh, where exports are very important, and they are small in the entire global system. And when a large country trying to break and rewrite the global system, a small country by itself cannot do anything. I mean, my view, if this goes further, the other countries should unite to the extent that, you know, we are thinking about Europe and China coming together, all the emerging bloc coming together, emerging bloc and Europe coming together. I mean, obviously this shouldn't be done on a whim, but it should be strategic thinking. But if you plot the shape of the supply chains, actually Europe and some emerging markets have a lot of advantages there. So the first thing to do here is somehow, you know, join forces with those guys, right? Especially a country that needs to import to export, and where exports are important, like Bangladesh. Yeah, so it's just, you know, tough times for everyone. So, but I mean, again, the problem is a large country is trying to rewrite the global system. That means there needs to be another large country on the other side. Yeah, so that's all I can say.
Yeah, thanks for that talk. I really, I really learned a lot from it. That was terrific. I had focusing on this again on the short-term disconnect issue, which is really, really interesting. I don't claim to have looked at all the number of countries that you have, but I have taken a look at 2 or 3 countries in Southeast Asia during this period of very wild capital flows, and noticed that these are countries. I looked at the Philippines and Indonesia for something I did for CSEN actually, and they had a policy target, of course, but they also had a corridor. They had a deposit rate and then a lending rate, in addition perhaps a repo rate and reverse repo rate to try to contain the market rate in between the upper and lower bounds. And so I'm wondering, does some of the disconnect you're detecting have to do with movements of the market rate within that corridor? So I looking at the data, I saw instances of capital inflows, and it would go to the bottom of the corridor, and then when the outflows, it would go up to the top, and it was sort of going to sort of from one extreme to the other. And I think a number of central banks during this period also became cognizant of the fact that the market rates, they were managed to contain the overnight rate or a very short-term rate in that corridor, but then things were getting out of control at somewhat longer maturity. So they instituted repos and reverse repos at 1, 2, 3 week horizons to try to reduce the volatility of longer horizons. So I'm wondering is the kind of short-term disconnect you're talking about related to that disconnect that I saw in the data, the interest rate fluctuating within that corridor, the corridors they're trying to contain? And if so, is there a scope for sort of mitigating that disconnect by taking more aggressive, having a narrow band, more aggressive intervention at longer maturities in the money market? Are those connected at all?
Yeah, no, we look at that. I mean, the paper, in fact, at some point we did country by country, every country by themselves, and different type of monetary policy making is definitely important. I only showed you one example there when we did the inflation targeting and the interest rate, but yes, there is the corridor one. There is actually some, explicit money supply targeting. So there are several different kinds, and you are right. There is a lot of heterogeneity. But in general, what we observed is, and this is also in the paper, you can go and look, the many dimensions of heterogeneity, this is being one. For the disconnect, what is more important is how much you're exposed to the external stuff. So you can still have your corridor thing, right? And the way your central bank can be dealing with that, yes, obviously these short-term instruments and liquidity is going to be important, but the counter-cyclicality of the dynamics of the wedge is really end up depending on how much externally you're exposed. So we in fact, for some of the countries, we kind of made this wedge like zero and not moving, very similar to advanced countries. This is, for example, a country like India is like that. Why? Because India is not that open. Their banks are not that much borrowing compared to a country like, Brazil, South Africa, Turkey, or Egypt even. So it really comes down to more the external exposure and your external borrowing conditions than how different ways of you are doing the monetary policy. So we did a lot on that, and that's kind of what we end up with.
Thank you very much. It was a very interesting presentation. My name is Nur Sultan. I am from Kyrgyzstan. So I have a question because in my country, we also, my country is developing, we're also facing this kind of problem. I mean, monetary policy transmission is very weak. Even you increase or decrease the policy rate, it doesn't channel to the lending rate. But in the presentation, I just wanted to clarify that you said that the main reason is that commercial banks, they have it depends on external funding condition, right?
Yeah.
So in that case, how about the adverse selection problems and collateral problems? We don't have to take into account these problems when it comes to talk about the monetary policy transmission, why a lending rate doesn't increase or decrease when you change your policy rate.
Yeah. No, this endogeneity we don't get into. I mean, Kenny's question can be also, combined with yours. So, why some countries do the corridor and the others do inflation targeting, and why, other countries are going to have these, governance, transferability, collateral problems. Okay, we don't get into that. And you are exactly right that the reason of that is related to external funding condition being more volatile, right? Having borrowing at a higher rate, or the banks, commercial banks, being subject to more kind of a bang type of thing. So whatever reason for that can also be the reason underlying some not less than perfect way of monetary policy making. That's we take as given, right? So in fact, we use these spread the rate they borrow from the foreign countries as given, right? So it's in the model. So in the model, it's an exogenous object. And in the data, we just measure it from the data. Same also for the amount. Now, but then, okay, so you can think about an endogenous framework, a more kind of a general equilibrium framework, where all these problems you are mentioning is affecting the monetary policy making. That's why they do the monetary policy in a certain way. and they cannot do the other way, say, okay, and that is priced in the foreign funding conditions, okay? So one way to interpret these results is, okay, you know, it's not just like what you do, like is it inflation targeting or corridor or whatever, but it is like how you do it, like the credibility. But, you know, central banks put it as a policy credibility, right? So, and all those things you are saying is also can be very damaging to policy credibility. So if you damage your policy credibility, then of course you increase, decrease, it's not going to matter, right? Or the way you try corridor way or that way, none of that's going to matter because the market is like, okay, these guys don't know what they are doing, so I'm not going to trust. And that market is the same, domestic or foreign. Now, foreigner is going to price that as a high risk premium, and your domestic market is also to a certain extent, right? So if you think this in that framework, then it is really important to do the policy credibly. And what is that really? It is not just like, you know, sticking to a particular form, but explaining it, being transparent about it, being accountable about it and explain it. And this goes back also to the COVID question and also, you know, this inflation we observe after COVID, right? That's a very good example. Remember I showed you the Brazil during taper tantrum, and if you go and read the documents of Brazil and IMF Article 4, you see the whole statement from Brazil Central Bank why they're increasing the interest rate, because they are observing these capital outflows out of the blue because of this taper tantrum and exchange rate is depreciated. Okay, this Brazil, that was 2013. This one in 2021, right, when the US even didn't start tightening. Remember, US Federal Reserve started tightening in the first quarter of 2022 for the COVID inflation, and also ECB, I think either the last quarter of 2021 or first quarter of 2022. Brazil and Chile and Peru, they tightened very early in 2021, okay? Now go and read their statements. They didn't change monetary policy making, you know, that time and this time, but the way they do it changed tremendously. Brazil now has a daily expectation index. Even Federal Reserve doesn't. Daily, they follow inflation expectations, okay? And when they put out this statement, when they start tightening in 2021, they said, we are tightening because there's inflationary pressure in the economy, and this is not, you know, consistent with our mandate. I mean, if you don't read like Brazil and Real, it's like a statement from the Federal Reserve, right? No capital flows mentioning, no depreciation mentioning, no external thing mentioning, right? This is how you see these results, I mean, from the perspective of your question, right? So it's not just really, you know, what type of monetary policy doing, but like you have to do what you are doing in the proper way, like explained and you know, very well, and you stick to it. That's when you are going to get results, right? So here, the external funding conditions are going to get in the way of that. But kind of don't make it worse. That's kind of the message here.
Thank you, Professor. I have a question.
Yes. Okay, yes, I see you. Okay, all right, great.
Does exchange rate regime have any role to play here, like in mitigating the exposure of external shock, or in the phenomenon of counter-cyclical in policy rate and market rate?
Yeah, exchange rate, I mean, you know, so many people will argue that, look, you do this Taylor rule, central bank reaction function, but there is really exchange rate in it. They don't tell you, but they really do it, right? I mean, you know, so everybody will tell you that, and you talk to, you know, privately to these policymakers in developing economies and emerging markets, they say, yes, we watch the exchange rate. I mean, even, you know, you don't have to go really, really developing. I mean, Stan Fisher, when he was the governor of Israel Central Bank, he said there are just two prices watching, right? The exchange rate and the interest rate, the spreads. And then he became number 2 in the Fed. He completely stopped watching the exchange rate because nobody cares about the dollar exchange rate in the Federal Reserve monetary policy making. So you can definitely have that view. And in the Taylor rule, in the standard Taylor rule, you have inflation output cap. You can add the exchange rate there. And we did that. And exchange rate is going to have the rightly signed coefficient, meaning, you know, so exchange rate, you know, depreciation or appreciation is in the policy rate, right? They are somehow targeting that partly. But that doesn't change the wedge. You're still subject to this counter-cyclical short-term disconnect wedge, right? Because, you know, whatever exchange rate is doing for you or against you, it is not enough. If it is working for you, it is not enough. If it is against you, it is making it worse. It depends on the risk premium, right? The story here is real risk premium. And then how much exchange rate is absorbing that or making it worse. And this goes back actually very interestingly to a discussion in 1940s between Nurks and Friedman, and I didn't know this. I mean, of course, people like Murray Opsfeld and Barry Ihangren knows this very well, and they told me to go and read this. Their historical knowledge is amazing. So they told me to go and read this, and it's very interesting. And this discussion is about, you know, should we go to floating or fixed? Which one is better? Is fixed exchange rate better or floating exchange rate better? And then there's this argument Nurks is making that, look, wait, we are missing the point that floating exchange rate is also going to have this role of absorbing the risk, okay? So that's completely lost in the literature. This is what we are trying to bring. A big part of my work is really try to remind that to people, right? Exchange rate, yes, exchange is depreciated, but some of that is absorbing that risk premium. So if you are going to make that risk premium worse with your own hand, with your own monetary policy making, that's not going to help you for sure. Yeah.
Good evening. My name is Estella from Zambia. I wanted to find out from you, most of us are from low-income countries, and perhaps the importance of commercial banks is not so much.
Yeah.
Does this still apply? Thank you.
For low-income countries, maybe not, you are right, and we don't have that. We have some low-income countries, but not that many because it's a data limitation, right? We need this data back to 1995, so you need long-time series, and it's just simply the data is not there. Okay, but obviously for those countries, exactly as you are saying, you are at the opening up stage, right? I mean, when you open up a little bit more, commercial banks are going to be more and more important because clearly the money is going to come there, right, after your government. I mean, generally low-income countries start with governments borrowing only, and then when they move a little bit more, now the banks are going to start borrowing. This is before the stock market or any private sector and all that. Okay, so, but still, you know, this doesn't mean, you know, they cannot adopt the monetary policy framework that they credibly follow, right? So they might have other problems there. I mean, again, this is at the end of the day, an average result doesn't meant to be a characterization of every single country, even among the emerging markets. But I think the importance of proper monetary policy making, credible monetary policy making still applies to those countries too. Because at the end of the day, I mean, for every country, as long as we start from central bank as an independent institution, that's very powerful, right? I mean, in fact, more powerful in those countries because it's the only institution that works in spite of government, against government. I guess we are going to see now what happens in the United States, but we are hoping still Federal Reserve is an independent institution and is going to do its job. But that's where you start in any country.
Yes, thank you. My name is Betuel Shao from Mozambique. I have one question regarding the main challenging in conducting the monetary policy. The question is how to conduct the monetary policy in the context of climate change. What are the main challenges, policy implication, and recommendation? Thank you.
Okay, I'm in the camp of monetary policy makers should stick to monetary policy making and not add to all sorts of other goals like, I mean, I'm not even in the camp of they shouldn't be doing anything with the exchange rate, right? So let alone climate change or fiscal or anything like that, right? So that should be all other policies, but not monetary policy. Now, you have a point that, of course, monetary policy should be consistent with other policies, right? And if we think climate is going to be under some sort of fiscal policy, because you are obviously putting some fiscal packages or industrial policy for your green transition, then obviously, and if you have an inflation problem in your country, your fiscal policy being stimulative and your monetary policy being contractive might be an issue, right? But still, this doesn't, I think, change the fact that monetary policy should do monetary policy, meaning in most countries it's going to be price stability. And in some countries like the United States, dual mandate, it's price stability and maximum employment. But that, you know, whatever its job is, it should stick to that job.
Maybe one last question, or two. If I'm given the microphone is in my hand, I'd like to use that for my advantage. So as you have said, the domestic banks have an important role here. They are one of the major actors, like in attracting the foreign capital. And as you've mentioned, also when addressing Bamsu's question, the nature of the frictions matter quite a bit. So given all this, I have a question about the financial development side. So what are the right domestic banking financial development policies that emerging markets can take in this context?
Yeah, this is very important. So, okay, domestic banks are kind of the gateway, but that's because they are the first intermediary there that your foreign guys are coming to, right? I mean, think from the perspective of the foreign guy. Foreign guy, you know, doesn't know your household, doesn't know your corporate. Okay, they might, you know, lend to government, but, you know, if they want to do more, they are going to come through banks. Now, but it is very important that, you know, domestic investor base should be developed. And I think that is domestic bond markets, right? If you want to be in a phase where you are now becoming more integrated, more advanced, then you have to be seriously thinking about the bond markets. And to be able to go to the foreign markets before doing that, you have to have a serious domestic bond market, right? I mean, think like Europe. I mean, even European bond markets are not to the level of American bond markets, right? I mean, domestic bond market is, I think, a very important financial development to go to that stage. What comes after banks, okay? So, and that would help you the domestic investor base and all that, right? I mean, then you might not have the non-bank problem, because non-banks is basically like banks. They call them non-banks because they don't take deposits, but they are not regulated entities, right? They just like pop up because banks are regulated. So to solve all this problem is really to develop a domestic bond market, which is what institutions like IFC, EBI, they have been working on this, like, I don't know, now maybe 3 decades, right? This is clearly not an easy thing to do. But let me say one last thing, which also goes back to this climate change question. Why it is important? I mean, clearly, you know, we have to do some regulation on the banks because domestic banks are important getaways to foreign capital flows. You know, apart from the government can borrow directly, of course. But why this is important, both to keep the domestic banks and also develop domestic bond markets, is right now the entire money going to the emerging markets is 1 trillion. 1 trillion. Okay, so I'm going to put this in perspective right now. So the CNI market in the United States, commercial and industrial lending, is a 4 trillion market. Okay, so I'm not even talking about the leverage market. This is just like regular companies, SMEs, small business enterprise. Just that, no households, just that market is 4 trillion. 1 trillion is the entire emerging market and developing country capital flows. What they need for green transition, is 1 trillion. Okay, so they have to double what they are getting right now. And this is just for the green transition, and they have to keep doing all other things. So there's very little capital flows. I mean, let's just like, you know, acknowledge this fact. And all the problems with the international system and then the US and all, they're all there. But, you know, developing countries and emerging markets also have to ask this question themselves. You know, what are the things that we can do so we can attract more, right? Goes back to your question. So domestic banks, of course, going to attract if, you know, they have good regulation, the foreigner knows that they are going to get their money back and all that. But this is a whole country responsibility. And monetary policy making is, I think, at the heart of this responsibility. Proper monetary policy making, where, you know, you can also borrow in your own currency. So the foreigners is like, okay, monetary policy is sensible in that country. I can lend them in pesos, I can lend them in dollars, and there is this high return. But we really need to be thinking about risk-adjusted return, not just like high return to low capital type of thing, because really developing economies and emerging markets need a lot of capital flows. And it is extremely hard in this environment right now where a large country is trying to break that system. Yeah.
Thank you, Şebnem.
Thank you.
Any additional questions? Yeah, so maybe one. Okay, Nursultan has another one, and maybe let's take this as the last question.
So my next question is, my country is also a dependent, reliant country, remittance dependent, reliant country. So the share of remittances to GDP currently around 20%, and we know that in emerging and developing countries there are a lot of countries that they rely on remittances. And then when it comes to conducting a monetary policy, so do we have to also take into account this factor like remittances?
No, remittances is not a big thing. So the capital flows here we are talking about, you want the foreign private investor, right? You want the global financial markets. It goes back to the IMF question and the COVID question. How much money IMF put during COVID? You know, somebody said my country got help and all that, 60 billion. 60 billion is the total thing they put together for whatever, 50 countries. I mean, if only like 6 emerging markets right now go to crisis, this is going to be in trillions, and there's no way IMF can pay that, right? IMF doesn't have that type of budget. So for all the things we want to do, green transition, development, infrastructure, all those, and also just in case we have a crisis, somebody helps us, that is like a huge amount of money. Okay, so neither remittances nor IMF is going to get it. So it is really global financial markets, global capital markets, and how to attract those investors to emerging markets and developing economies. That's the key question. In spite of all the mess these countries' governments are doing, in spite of the governments, how do we do that? That's the big question. All right.
Yeah, thank you. I would like to thank Professor Kalemli-Özcan and close this session. It was a wonderful talk, full of messages, full of recommendations for policymakers as well as for researchers like ourselves. Thank you very much.